in the long term, it would be a better situation if the United States had a real nominal interest rate and a real interest rate that started with a more normal front end 3%, say on a Fed funds rate, and a 4.5% 10-year rate. That is more what we have had over time. We had a very odd period from the financial crisis, really interrupted a bit by the pandemic, but long-term growth. We barely got rates up in 19, and they were cutting rates again because inflation and the growth was not sufficient. So I think the trick now is not to overcorrect. And when you talk to central bankers around the world who lived through that long period of time, they're saying, wait a second, if we choke off inflation now and choke off growth, isn't that what we tried for 10 or 15 years to get to that we couldn't get to? So I think the tough part for the Fed is how do they bring this down, but not bring it down so fast they put us back in the trough of low inflation, low growth. And I think the good news is with the consumer spending we see, that's consistent with a growing economy. And they've got a real interest rate across the curve now in terms of that. They've taken a lot of monetary accommodation. They've shrunk their balance sheet. And so as the tariffs and other things, new policies go through, they can react to that. But they shouldn't be premature to try to goose the economy when it's growing at 2%. It's kind of interesting. People might predict one lower than 2 this quarter, but the reality is first quarter sometimes is lower. But if you think about if people are predicting 2% growth, we were dying to get there for a long period of time, and we couldn't get there.